Good evening, everyone. I'm your host, Paul Lawrence Van, and of course, our host, Wealth Academy podcast. And our mantra is what? Wealth is more than just money. And we have a tremendous guest here today, and he's going to be talking about how to build a quality investment portfolio. And his name is Michael Prendergast. Michael, how are you doing this evening, my friend?
Fine, fine, Paul. How are you doing? Thank you so much for having me on the show. I'm very honored to be here.
I'm honored to have you here, and we're going to have a great time because you have the goods. You have the things that people are thinking about in the early part of 2022 in terms of looking at their financial goals, investments, and more. So I'm going to read Michael's bio here real quick, and we're going to get started and get your notepads out because you're going to learn quite a bit. Well, first of all, Michael is a director at Altfest Personal Wealth Management firm, and they are based in New York. And let me tell you a little bit about him. He graduated from Amherst College with a degree in Russian studies. Then he went on and received an MBA at the Stern School of Business at NYC. And that's not all. He also received his degree from Pace University as a certified financial planner. And this is just letting you all know to get those notepads out because you're going to learn a lot because Michael has about 2 decades of experience working with Altfest, and he helps people to work with their different aspects of their investments and personal financial planning. So this is something you really want to pay attention to. So Michael, if you're ready, I'm ready, and we're going to get into these questions.
Sounds great. Let's go
All
to it.
All right, we're going to have a great time. Again, our topic is building a quality investment portfolio. Now, Michael, what is the genesis for you becoming a wealth management expert? This is something that not everyone does everything, but what was the inspiration for you?
Well, I guess it was a few things. All my family, I've been very fortunate in that all my family has been involved in finance one way or the other. So my father was a banker, and also my grandfather. One of my uncles was a stockbroker, is a stockbroker.
Oh, good.
And another uncle was in insurance. So I always had personal finance, talking about various aspects of money and finance since I was a little kid. And then I also saw that how people who manage their money well were able to take care of their families and achieve their important goals. And then people who made either accidents or didn't have that knowledge could be really seriously hampered by that. And I wanted to help.
Well, that's wonderful because again, that's a generational type of upbringing, and I think it's just wonderful because you have your eyes on the prize. I think that's very important. And like you stated, that it takes work to do what you do, and you've seen it over the years, which I think is just wonderful. So thank you so much for that. Now, you also, as I mentioned before, the director of Altfest Personal Wealth Management. What is their mission and how does your company serve its clients?
That's a good question. Well, our mission basically is to help our clients achieve their important life and family goals and we do that by optimizing all areas of their personal financial lives, not just their investments, which tends to get the most attention, but all the different areas that you can think related to personal finance. And we do it in a way that is completely objective,
Uh-huh.
transparent to the client, and always puts our client's interest first, beyond in front of the interests of ourselves and the company at all times.
That's wonderful because, again, a lot of times when you have clients, they don't know the intricacies of investing and looking at their personal finances, and to bring an expert in to guide them is really one of the keys to helping them to achieve their financial goals as well. So that's definitely something people can really count on when they invest with experts at Altfest Personal Wealth Management. Now, again, we're in the infancy of 2022. My God, I mean, the time is really going by fast. What is the best approach for prospective and seasoned investors to take to establish wealth creation investments this year?
That's a very good question, and definitely it's January, so it's the beginning of the year. We've got people want to do New Year's resolutions and start the year off right. So here's some things to consider.
Okay.
Before we even get to the actual specific investments, you want to kind of make sure that you have your financial house in order. So some of the things that I would put out there is to, one, make sure that you have a sufficient emergency fund,
Yeah,
in case, you're going to lose your job or your spouse loses your job or you get into an accident. That can range at a very minimum of 3 months
exactly.
of living expenses, all
Hmm.
the way up to, let's say, 6, 9, even 12 months, depending on how um, volatile your job situation is.
Absolutely.
A second
Absolutely.
thing would be to pay down any high interest debt if you have it. If you have high interest credit card debt that you've used because you really needed to purchase something or you wanted to, you want to pay it off as soon as possible, because the credit cards aren't really doing you any favors by giving you a break on the interest rate. Those rates can be really, really high. So you want to get
Absolutely.
that high interest rate down as much as possible. Third, once you've gotten that taken care of, you want to contribute to your company's retirement plan. If you work for a company that has like a 401k or a 403b, and
Yeah.
which is a type of retirement plan that allows you to put money away on a tax deferred basis, you don't pay the taxes now, it's shielded from taxes till you take it out. And especially if your company offers you a matching component, meaning that for every dollar you put into the retirement plan, they might give you a dollar free or 50
Yeah.
cents free up to a certain ceiling. You definitely want to take advantage of that, because that's basically free money.
Yes. Added value.
Exactly. And the good thing is also, you don't have to worry if you're self-employed or you have your own small business. You can create your own workplace retirement plan. So you don't have to worry, like if you're working for yourself or you have your own little company, you're thinking, well, I don't have one. You have the power to create your own and
Yeah.
choose the one that works best for you and your employees if you have them.
Yes. So that's a win-win, especially for the people who are working full-time and entrepreneurs.
Exactly, exactly. In fact, you could even be working for a company and have a side hustle, and you'd be able to put some money away into a retirement plan for your side hustle.
Yeah, and I think that's what's happening when we see the great resignation, that a lot of people are leaving the jobs. They have enough to start a business. And these are the type of concepts that they inherit. They want to do this because they
Exactly.
want to depend on themselves.
Exactly, exactly. You want to put that money away for a rainy day, and then you want to grow it over time so that you can achieve financial freedom as soon as possible, and then you'll be able to do what you want to do whenever you want to do it. Which I know a lot of people always have those goals to do exactly what they want to do, and you're doing the work now to get the payoff later.
Yes, it's looking at it from a long term. Yes.
Another thing for 2022 at the beginning of the year to be thinking about is, think about whether your investment goals, or not even just investment goals, broadening it out, your life goals, your family goals,
Yes.
or your time horizon for your investments have changed.
Uh-huh.
If you've changed the things that are most important to you that you're trying to save and invest your money for, then you might want to change the composition of your investment portfolio. Or if your
Exactly.
time horizon has changed or some new goal has jumped in, let's say you want to put a down payment on a house and you're not just saving for retirement, then maybe you're going to have certain investments that have a different time horizon to pay for the down payment on the house, and other investments that will have a longer time horizon, maybe for planning for retirement.
Absolutely. That's a really a great recommendation right there, because really, if a person is not within that retirement age, working for the company, it's looking at the long haul. It's all about the long haul. The earlier one invests, the more they will have at the end because of the compound interest. But
Exactly.
but for the most part, people really need to focus in on the long haul, and it's not a overnight success, if you will, for the financial goals.
Exactly, exactly. You're going to put in the work and then you're going to get the
Yeah,
benefits later. But if
on the
you put
back
in the
end.
work, you will get those benefits.
Absolutely, absolutely. So thank you for that, Michael. Now, what are some common mistakes people make? Because we know they make them, but when it comes to making investment, what are some of the mistakes they made, and how can they avoid them today as well as in the future?
Sure, sure. People make lots of different types of mistakes, and I understand, because it's not that they're making them because they didn't study for the test. It's just that
Exactly.
if you're not working in this business, you don't know the mistakes to avoid.
Correct.
You're not an expert in investments. No one expects you to be, and so it's easy to fall into common traps.
Correct.
So one of them, which gets a lot of, which some of your audience might have heard, is trying to time the market.
Right.
Now, this is when you're trying to invest when you think is the right time, when things are really going to do well. So, for example, you might say, I think the economy is going to do really well soon. I think stocks are going to go up. I think bonds are going to go up. So I'm going to put money in a lot of stocks right now because I think stocks are going to do well in the next year.
Sure.
Now, maybe they will, but maybe they won't. And any investment professional or financial professional who tells you that they know what's going to happen in the next 12 months
Uh-huh.
really is selling you a bill of goods. No one has a crystal ball. And
Correct.
while we might be able to predict what investments will do over a longer time period, let's say roughly over 5 to 7 years, you can say on average stocks might behave like this or bonds might behave like that. In a 1 year time frame, it's so short that anything could happen. They might go really up, they might go really down, or they might be very neutral. So you don't want to, load up on stocks when you're feeling positive, and conversely, you don't want to sell all your stocks when things are going down and you think it's the end of the world. I can't take the stress. I better get out while I can. Buying and selling when you think are the right times for the market to behave in a certain way is a great way to lose money. In fact, that's one of the ways that we at Altfest help our clients the most, is when the markets are very volatile and clients are calling us up and saying, oh my gosh, the markets are going down 10, 15, 20%. I think I should sell everything. I can't take this. And we try to calm them down, kind of talk them off the ledge and say, wait a minute, what are your goals? Are your goals, and do your goals end after 1 year? Is the 1 year mark is when you'll decide whether the finish line was positive or not? No, your goals tend to be much longer. So you want to give the investments time to grow, and there'll always be periodic downturns, but you don't want to let the temporary headlines cloud your thinking. Realize that, like you said, you want to have your eyes on the prize. The eyes on the
Right.
prize is retirement. That could be
Right.
10, 20, 30 years away. You want to make sure your portfolio, it will do well in the 10, 20, or 30 years if you
Exactly.
don't make any sudden moves and treat it with care, but don't let your emotions control your actions.
Absolutely, because unfortunately, a lot of people, especially when it comes to stocks, that they're assuming that they're becoming overnight success because they're reading the newspaper, looking online, and a lot of people are saying how much success they're having. But it's really all about the long run. Let's say if they put in for a stock, invest in some stock, even if they hold it for 5 years, that's a lot better than putting it in for a year and a half and taking it out, cashing out.
Exactly. In fact, there's one statistic that sits in my mind a lot, which when I talk to clients, which is that Morningstar, which is a
Uh-huh.
investment research company, they
Exactly.
did an analysis and they looked at the time period between 1999 and 2018, so roughly about 20 years, and they saw the S&P 500 index,
Yes.
which is large cap US growth stocks. I mean,
Mhm.
large cap US stocks, some growth, some value. And they saw that over that 19, 20-year period, there was an annualized rate of return of about 5.6%.
Yes.
But then
Uh-huh.
they noticed that if you got out of the market because you were afraid and then took a while to get back into the market and you missed just the top 10 best performing days,
Yes.
then if you miss the top 10 performing days over those 19 or 20 years, your annualized return would have gone down from about 5.6% to about 2%.
Wow.
Can you imagine that? So you
Uh-huh.
just missed the 10 best days and already your performance takes such a big hit. So you don't know when the days are going to be great. You don't know when the days are going to be terrible. So you really want to ride out the storm and be
Exactly.
able to get out of the hole by investing for the long term.
Yeah. Great, great recommendations. And as you stated, it's all about the research that you do, and that's what you do with your personal wealth management company. You all do the research for your customers and for your clients, and so you
Exactly.
take that burden off of their hands and get them to relax a little bit. And I know that's not easy when money is involved.
Exactly. And another common mistake that clients make, which again is very natural if you're
Yeah.
not working in the industry, is people tend to naturally think that what has done very well recently is going to continue to do very well in the future. So we have a lot of clients who say, especially at this time of year, they look at their portfolio and they say, Mike, in 2021, these types of investments did really well. So why don't we put much more of them in the portfolio in 2022? And these investments that did pretty poorly in 2022, let's get rid of them. We don't really need them. What are they doing in the portfolio? But people often don't realize that different types of investments perform differently under different market conditions.
Yes, different industries. Yeah.
Exactly. So you want to have a diverse set of investments that will naturally behave differently when under the same market conditions. And that's why some will be doing well in one year, others will be doing well in another year. So for example, in 2020, international stocks did really, really well, phenomenally well. We had a lot of clients who said, oh my gosh, let's just put more and more and more in there because I want some more of that greatness. And we said, no. We strongly believe in international, but you don't want to have too much in it because if they don't do well, your portfolio is going to really get hurt. And so in 2021, international stocks did actually not very well. They actually were positive to slightly negative, depending on how you look at it. So the thing is, don't look in the rear view mirror to see what's done well and assume it'll do well in the future. You want to have that diversified portfolio of all different types that will do well at different times.
Right. When one is not doing well, the other is. And so it creates that balance out there for them.
Exactly.
Yeah. Thank you for that. That was really a great example as well.
So, and if I can, go ahead, please. Sorry for interrupting you, Paul.
Oh, no problem. Take the listening audience down Main Street, Mike. In other words, for those people who are not as seasoned in understanding and conducted self-research for investing. In other words, how does one build a quality investment portfolio that will potentially last for them?
Sure. Very good question. First of all, after we've covered all the stuff that we talked about previously in terms of paying down debt and so on, you first want to think about what target asset allocation do you want to have for your investment portfolio. And by target asset allocation, I mean, what is the target you would like to have for stock-based investments? And what's the target percentage of your portfolio you'd like to have for bond-based investments? So, for example, you might want to have 65% in stock-based investments and roughly 35% in bond-based investments. And why is this important? Because that investment portfolio will have a different risk profile, a different amount of volatility that portfolio will have versus if you have a portfolio with 80% of stocks in the portfolio and only 20% of bonds. So first you have to choose what is the target asset allocation percentage of stocks to bonds that you feel comfortable with over time, that you can handle, because that stocks go down about on average, 1 out of every 4 years. So there are going to be times when stocks are down, and it's a question of how much down can you take and have a strong stomach and not feel like you're going to want to sell out when things are going down because you just can't take it anymore. But rather you say, okay, it's gone down. I was expecting that. Stocks don't go straight up every single year, but that's okay. I'm not really using that money. It's for the medium to long-term goals, and I'm going to ride out the storm, and I'm okay with that loss because it's a temporary loss. I always like to say it's only a loss when you sell it and then lock it in. Otherwise, it's just a paper number, and that number changes over time.
Yeah, and then there are some tax implications as well.
Exactly. Once
That's what they have to be careful about.
There are very big tax implications which you want to protect yourself against. The next thing you want to do, some important factors to consider for your portfolio is, like we said, the power of diversification. You want to have a variety of different types of stocks. You want to have a variety of different types of bonds. So, for example, you want to have stocks of different sizes, small, medium, and large capitalization companies. You want to have international stocks as well as domestic stocks. You want to have stocks that are focused on growth-oriented stocks versus value-oriented stocks. So you want to have very different, because they behave differently. With the same type of market conditions, they can behave very differently. And like I said, when one's doing strong, the other one will be weak. And then when one gets weak, it's like a relay race. One passes the baton to the next runner, and then both stocks take the lead. You also want to have things like different types of bonds. You could have treasury bonds, corporate bonds, inflation-protected securities, asset-backed bonds. all international bonds, whether it's international sovereign debt or private company debt, all these
True.
different bonds again will behave differently with the same type of market condition. Another thing to consider is, like I was saying, growth versus value investing.
Yes.
Neither one is right all the time. There are times when value philosophy does very, very well, and then
Uh-huh.
times when growth philosophy is doing very well. Value investing is basically meaning when you want to buy things that you think are selling for less than their intrinsic worth. So you're
Yes.
buying at a discount, and then you think that you'll wait till the market realizes the true worth of the investment and it will go up. And then growth
Right.
stocks are when investments that are doing very well currently, and you think that they will continue to do very well above the market average over the foreseeable future. So, for example, like the Amazons of the world or the
Exactly.
Alibabas of the world. And,
Yeah. Hmm.
and we recommend to have a diversified pool of investments. We tend to be a more value-oriented investment firm. We
Uh-huh.
tend to look at things where we buy at a discount with a significant discount to their market value. So we have a good cushion in case the volatility temporarily goes down. But we are willing to buy growth-oriented stocks if we can get them at a reasonable price.
Yes. And I'm pretty sure clients, they're probably, they get a little nervous.
Exactly.
It's that their value is going down. They want to pull it out. And then when it's going up, they want to just, like you said, drop more in there, invest more. So it's a matter of having that balance and listen to the professionals. Let the professionals handle that.
Exactly,
Yeah.
exactly. And then you want to consider, there's active investing versus passive investing.
Perfect. Right.
Active investing where, active managers are taking an active role in choosing the investments and doing all the analysis and thinking this is a good time to have this type of investment, building a diversified portfolio and so forth, where we actively make, buys and sell calls to optimize the portfolio based on our outlook on the economy and the markets. Passive investing is basically just, buying an index. And I always like to say, you can do that if you want, but basically you'll float along like a cork, a bobber in the ocean. And when the
Exactly.
market's doing well, you'll float up. When the market's doing terribly,
Exactly.
you'll float down terribly. Whereas
Absolutely.
an active manager is trying to beat the benchmarks over a reasonable time period, over a full economic cycle, not just do the market averages, but do beyond the market averages.
Exactly. So it would behoove some customers before they come to you to also have some self-knowledge as well, to learn a little bit about the markets before they actually uh, engage, correct?
That's
It would
correct.
help.
That's
Yeah.
definitely correct. We are an actively managed wealth management firm. We actively manage the portfolio based on our outlook on the economy and the markets, and we meet the investment managers of the various types of investments, and we will
Okay.
make certain calls in order to optimize and beat the benchmarks over a full economic cycle, which is usually about 5 to 7 years.
Okay. Yeah. That's really good. That's really good. So at least a person, if they have that 5 to 7 year window, they're going to come out of pretty good. Pretty
Exactly,
good. Yeah.
exactly. And
Yeah.
then, of course, if you're in order to have strong investments, like you were saying, to have investments that are going to be a quality investment portfolio, you
Yeah.
really want to either do the research, yeah, and research mutual funds, research the ETFs, research the individual stocks and bonds. There are resources that you can use. For example, Morningstar, which I talked about,
Exactly.
Yahoo Finance,
Uh-huh.
Value Line, which is a great database for analyzing individual stocks,
Exactly. Yes.
various brokerage sites like whether it's at Fidelity or Charles Schwab or
Yeah.
TD Ameritrade. Um,
Uh-huh.
Another great resource is the American Association of Individual Investors, which has a lot of great knowledge on how to research investments to choose them
Yeah.
yourself. It
Yeah.
does take a lot of time, though. So I always say, people always will say, um, you know, how do I know whether I want to do it myself or not? If you want to do it yourself, you can, but you really need to have a lot of time because it's a lot
Exactly.
of research.
And a lot of patience.
You want to have a lot of patience, right? You also want to get a lot of experience under your belt because it's easy to get, spooked by the markets until you have
Exactly.
at least several years under your belts to understand how the markets operate. You also want to have some ability because just like, I'm not a painter, I'm not going to be Michelangelo anytime, no matter
Sure.
how much I try to paint. Certain people
Uh-huh.
have a natural ability towards finance and numbers, investments. And then even if you have the time and the ability, you also want to have the interest. You
Yeah.
want to have the interest, you want
Mhm.
to have the ability, and you want to have the time to actually do the work.
Absolutely, absolutely. Thank you for that. And I think the people who went down Main Street, they ran into a few green lights, yellow lights, and red lights. That was a great example that you provided, which I know is going to help a lot of people. So thank you.
My
Now,
pleasure.
Mike, you're also a certified financial planner. Why should listeners hire a CFP to work for them rather than go it alone? And I think part of it, you just referred to that.
Sure, exactly. Well, I would say that, like I said, if you wanted to go it alone, it can be done, but you really have to put forth the effort, right?
That's it.
You
Yeah,
can't just kind of do it as a hobby because this is your money you're talking about, right? You can't
absolutely.
kind of dabble in it. You can't read. Like I asked one person who was a prospective client, and he said, "Oh, I'm doing it myself. I'm very happy. I'm doing it myself." I said, "How many hours do you spend on your investments and your personal
Exactly.
financial planning in all the different areas a month?" And he
Sure.
said, "Well, I read, Kiplinger's Personal Finance
Uh-huh.
when it comes out. I probably spend, at least 3 or 4 hours a month on this."
Oh,
And I
not
said,
enough. Not enough.
"Well, that's nice, but that is kind of dabbling. That's kind
That's
of
a
like a hobby.
that's a
But
hobby.
you wouldn't go if you needed heart surgery. You wouldn't go to a heart surgeon who did this like 3 or 4 hours a month. You would want to go
Exactly.
to the heart surgeon who does operation after operation after operation and really gets it to like a finely grooved machine. And
Yeah.
so, if you have the time and the ability and the interest, more power. And you want to do it yourself, I'd say more power to you. Knock yourselves out. However, for most of us, you want to find a professional. And the CFP, or Certified Financial Planner,
Hmm.
is the gold standard for personal financial planning.
Exactly.
In,
You
in
have,
order to
you have to
be,
meet industry standards.
yes, exactly, exactly. And people say, well, what's so special about a CFP? Why is that the gold standard of personal financial planning designations? And I say because of what you have to do to get the designation. You
Exactly.
have to complete the education coursework,
Uh,
which has about, 6 classes on all the different areas of personal finance. Plus, you
mhm.
have a capstone class, which integrates all the different areas where basically you create a personal financial plan for a fictitious family to make sure all of their areas of personal finance are optimized, and it's reviewed by a panel of CFP experts. You also have to pass a rigorous 6-hour, one-day examination,
Woo.
and you have to have 3 years of qualified
You have to
work
go further.
experience that's related to the personal financial planning process. Only then can you call yourself a CFP. So CFPs are educated, experienced, and knowledgeable about all the different areas of personal financial planning. So they've kind of got your back no matter what life throws at you on the finance side.
Absolutely. Yeah, that was a great example that you provided. For example, with me, I have 40 hours of accounting. I've worked in an accounting firm before, but when it comes to taking the CPA, I just have not convinced myself to take the test.
Right, exactly,
So yeah,
exactly.
you have to be ready for it. So I have a follow-on question to this, Mike, and it's this. What are a few of the key things one should look for when choosing a financial advisory firm to represent them? Because again, having that firm is a team, and so they actually cover more data, more research, and they're talking to more of the people who are in the financial arena.
Sure. In fact, that's a great question because many people naturally wouldn't know how do you find a good financial advisor
Exactly.
or financial advisory firm that could be good for you. A couple of things to look at. This won't be comprehensive, but some of the key things are you want to ask the people that you're interviewing at the firm, what's your education in the personal finance? What's your
Uh-huh.
experience, like we were talking about with the CFP? Like, how many years of experience do you have doing this type of work?
Sure.
What education have you garnered to help you get the knowledge in order to help others with their personal finances?
Uh-huh.
You also want to ask the financial advisory firm, what services do they provide? Many firms will just provide investment knowledge, and that's good, but
Uh-huh.
that's a start. You want to have ideally a firm that focuses on comprehensive wealth management that
Yeah.
can help you in all the different areas of personal finance. Whether that's questions related to tax, questions related to estate planning, questions related to when's the best time to take my social security,
Exactly.
all these different areas. Because I know that some of our clients, they really like the fact that we don't kind of say, like one client I was speaking to about a week ago was saying it's kind of refreshing to work with us because when he was working with his old financial advisor, he would ask a question about tax, or he'd ask a question about, estate planning or insurance, and they would say, "Oh, sorry, I really can't help you there. I just do investments." And
So not comprehensive. So in other words, he basically had really a cookie cutter type firm he was working with. He didn't have a specialized investment firm.
Well, right. He was just focused on investments, and
That's it.
anything you ask outside of investments, he was not able to help you. So our client likes that we're kind of like a one-stop shop for
Exactly.
people's financial lives, and they can feel comfortable to ask anything that they would like.
Oh, that's wonderful, wonderful. So for everyone who's out there and you're taking notes, what you just heard is what you need to write down.
Another thing that I would say, Paul, or some other things are, you want to hire a financial advisory firm that adheres to a fiduciary standard.
Yes.
And what does that mean?
Mm-hmm.
A fiduciary standard means that person is the advisory firm, and those advisors are legally required to put the client's interest first all the time.
Yeah.
You want in fact, some financial advisors, they only put their clients first some of the time. So you really want to say, are you legally required, and would you be willing to put in writing that you will always put my interests first 100% of the time? Most advisors, you'd be surprised, Paul, but most advisors do not put their clients' interests first 100% of the time. I'd say only about 5 to 10% do it 100% of the time. Right. So if you ask them to sign a piece of paper that says 100%, you're going to see a lot of people running for the door. But you want 100% because you don't want to be worrying like, are they putting the company's interest first or their personal financial gain first in front of me and my family? I know with my family, it's so important to me. I really want to make sure that whoever I work with, they're going to always have my interest first. Absolutely. Another thing that's important is, how are they compensated? Yes. We advocate a fee-only compensation structure, and people say, well, fee only, what does that mean, Mike? Well, that basically means that the only fees you pay are the fees that you transparently, clearly see that you are paying directly to the advisory firm. There are no commissions, there are no referral fees, there's nothing, hidden from view. You are being paid a straight fee for the services rendered, either on an hourly basis or on a percentage of the assets that we manage for you basis. But you never have to worry that there's anything that you're not being aware of. The fee is transparent, it's clear, and it's simple to you.
So that makes it as risky as investing in stock. If they're only can handle one area and they don't have the comprehensive overview and resources that a firm such as Altfest has.
Exactly. And of course,
it makes it riskier.
Exactly. And of course, you can always review a firm's what they call an ADV, a Form ADV, which is the firm that the SEC, the Securities and Exchange Commission, requires all firms to have to explain things like, the compensation structure, the services that they provide, and especially the disciplinary history of the advisors. You don't want most advisors are good, but some advisors, we know in every group there's some bad apples, and you want to steer away from those bad apples.
Exactly. Yes, to be forewarned is to be forewarned. All right. So let's take a look at your company's outlook on the markets and economy as we start 2022. We know at this point in time, in the early infancy of the new year, a lot of people are looking at financial goals. They're looking down the line. So when it comes to your company, Altfest, what is that outlook on the markets and economy as we start this new year?
Sure, exactly. So like I said, no one has a crystal ball, and anyone who says they have one, run far away from them. But by researching all the knowledge and seeing what's going on with the economy and the markets and various databases that we subscribe to, we see things in a certain way. So on the economy, we're cautiously optimistic on the economy. Last year the U.S. gross domestic product is predicted to be about 5.6%. Which is very, very good. Very, very good. Exactly. We expect the gross domestic product this year to still be good, but not be as good as 2021. So we expect about, let's say, 3.5 to 4% growth in the U.S. economy, which is still much better than the roughly 2% growth that the U.S. economy was seeing before the coronavirus happened.
Exactly.
We also one of the things that we think is going to reduce the growth this year versus last year is that, coronavirus is going to be Omicron is going to be reducing consumers' enthusiasm, I should say, for spending on services. When people are kind of more inside, you're not traveling as much, you're not going to be going to restaurants as much. That reduces the value of those services in the economy.
For sure.
We do, though, on the positive side, expect these shortages of goods to be reducing as 2020 progresses. So we know that there have been a lot of supply chain bottlenecks which have caused prices to be going up, and we do expect those to reduce as the year progresses. Actually, the supply chain bottlenecks and also the fact that we're at near full employment in the U.S. for people who want a job is those two things are causing inflation to pick up.
Absolutely.
And inflation is going to be a big concern in 2022. At the end of 2021, inflation, November, December was roughly, in the 6%, 7% range, which is the highest it's been in like nearly 40 years.
Yeah, and that's when President Reagan, when he came in, and interest rates on mortgages were in the teens.
Exactly. 1982, things like that. Double-digit inflation, double-digit interest rates. And so what the Federal Reserve is going to be trying to do this year is to lower inflation, but not cause a recession. So it's kind of a balancing act. They want to reduce inflation, but that will reduce the growth of the economy, but they don't want to do it so much that we spill into a recession. So the Federal Reserve is going to be having a balancing act. We do expect some interest rate increases in 2022. They could come starting as early as March. And we also, the Federal Reserve has telegraphed to the markets and the investors that they plan to reduce over time the amount of bonds that they're purchasing on the open market. So they're going to be reducing the amount of money supply that's within the market.
And so nowadays it's more of a global aspect. What the way and direction that the United States goes, the rest of the world goes.
Right. And you also want to keep in track what other economies are doing with their inflation rates that their central banks are setting. But right now, so far, the U.S. Federal Reserve, knock on wood, has been doing a pretty good job in terms of trying to fulfill its both mandates of good unemployment, so people have jobs, but not runaway inflation, so people's purchasing power doesn't disappear.
Exactly. Absolutely. Those are some great insights. And again, as you stated, it's not necessarily a crystal ball, but it's some of the indicators that are out there that have been researched and that has happened over several years.
Exactly. And on the market side, to let you know how we're viewing the markets as opposed to the economy, we're seeing that right now, U.S. stock valuations are very high. There's a valuation metric, which some of your viewers and listeners may have heard of. It's called the price to earnings ratio. And it's the price that you're willing to pay for every dollar of a company's earnings. And right now, for U.S. stocks on average, it's a PE ratio of about 21, which is much higher than its historical average of about 16. And this is due in partly because of the low interest rates, which are causing people not to be very interested in bonds as an investment because they pay so little. They're putting more money into stocks and raising the prices of those stocks. So because of that, technology stocks also have very, very high valuations. While they did very well in 2021, we don't expect technology stocks to do as well in 2022 compared to other regular stocks, I would say, that have a good profit outlook. We expect the regular stocks with good profit outlooks to do better than technology stocks on average. We also expect value stocks. We think that they'll perform on average better than the growth stocks in 22 because, again, they're much more reasonably priced and they often tend to be more cyclical stocks, which will do better when the economy is doing better. So we think value stocks have more room to grow, but the valuations of growth are so lofty that they're kind of priced in for only good news. And if some bad news starts happening, their prices could start coming down. We also, on the valuation level in the markets, we like international stocks. Like I said, we have a significant component in international. And why is that? That's because we see that the valuations, the price that you will have to pay for every dollar of earnings of international stocks is much lower, much more competitively priced than U.S. stocks, which tend to be overpriced. And especially in we're bullish on Asia. So
Yeah.
Asian companies on the technology side and the consumer product side that are focused on consumers, we think that those will be doing well in
Yeah.
2022. And even if there's some temporarily
And they
downturn in
have
the
a
market,
pretty solid countries as well as far as their economy goes.
exactly, China,
Right.
Southeast
Japan,
Asia, Korea,
South Korea,
Japan, India,
Singapore.
and
Yeah.
so forth.
Hmm.
And even if there's some temporary hiccups in the market and some stocks don't do very well in a year, don't lose the faith, because if you're able to buy them at attractive prices and then
Sure.
hold them until people's rational side comes back and people see that, wow, that these things really are at a steal price, I'm going to buy some of them too, and their prices will get bid up to what they're really worth. And then when it hits your target sell price, we can then sell them.
Got it. That is awesome. I tell you, this is really a remarkable assessment that you've made here, and we really appreciate it. I know the Wealth Academy podcast community appreciate it. So, Michael, our time is coming to an end. I can't even believe it. I've had so much fun. Is there anything else you would like to share at this time? Your contact information, upcoming programs, etc.
Sure. Well, one, I just wanted to say again, Paul, thank you so much for
Sure.
having me on the podcast. It's a great honor to be here, and I know that you do a lot of great work spreading a lot of knowledge to your audience. And so thank you for all your service to helping your audience community get stronger in so many different ways. Like you said, it's not wealth. Wealth is not just about money. It's
Money,
about
right.
all the different types of wealth. So thank you for that.
Yeah.
I did want to say one thing, and then I'll give some contact information, which is that when people think about personal finance, they tend to just think about investments. Investments is, for lack of a better word, like the sexy thing. Everyone's talking about it. It's on the television. It's everywhere. But there are many other areas of personal finance which people need to consider in order to make sure that they're all optimized. So it's kind of like a car. Investments might be the engine, but all the other different parts of personal finance are, the steering wheel, the doors, the heater, the wheels, everything else. So you want to make sure that other things are being optimized. So for example, you want to be like, are you on track to retire when you want to retire in the lifestyle that you would like? That's retirement analysis.
Exactly.
Are you saving for your children's education in the most tax efficient manner? Are you taking advantage of all the relevant tax savings opportunities focused on the tax? Do you have like the right types of insurance to protect your assets and your family against important risks? And if you do, are those insurance policies optimized for your specific life situation and that of your family?
Exactly.
In terms of transferring wealth, pardon me for interrupting you, Paul. In terms of transferring wealth, when you do you have an estate plan so that you have the documents that will help you transfer your wealth to the people you want to transfer it to in the way you think best and in the most tax efficient manner? And another thing, that this isn't a comprehensive list by any means, is you want to what about Social Security? What's the best benefit claiming strategy for you? And I could go on and on and on. So you see that there are all these different types of things beyond investments that your personal financial advisor should be able to advise you on. And I would say that, anyone in terms of contact information, anyone who is interested in reaching out to us and wants to learn more about our services and how we potentially might be able to help them, probably you could definitely either, contact me at Prendergast at altfest.com.
Yes.
Or what's even easier, because who knows how to spell Prendergast, let's be honest, is you can go to email us at inquiry at altfest.com. That's ALTFEST.com. And I would say if you put it in the inquiry, which is the easiest, I would just address it to one of my colleagues, Jesse. And say, Jesse, that you heard about, you heard from Mike, and when Mike and Paul were talking on the Wealth Academy podcast, and Mike said that I should talk to you about learning about Altfest and how we potentially could help you.
And that's Jesse. Is that Jessie?
Actually, that's a great question. It's Jesse, Jesse.
Got it. Okay, fantastic.
He's one of my colleagues, and he will definitely, he's a very knowledgeable in his own right, and he will definitely start you on the path to learning about Altfest, where we can have a complimentary discussion, learn about your personal situation, what are your important key life and financial goals, and show you how we can help if we can. If we can't, we'll try to point you towards resources which will be able to help you.
Exactly. Well, I want to say this, Michael, is that you really made a strong case for people to sit down and really think about what they want to do financially, having financial goals. What I always say is that when a person aligns their finances with their life, they're living their best life possible. And instead of trying to figure it out, do something about it. I think tonight's interview is one where people can really take a look at it and really assess what they need to do to try to hit some targets on some financial goals. In the interim, at this current time, and towards the end of this year, the first quarter, second quarter, on and on. So I really thank you and appreciate all that you provided, so much content-rich value that you provided here this evening, representing Altfest Personal Wealth Management. So thank you very much.
Thank you so much, Paul. Like I said, it's been great speaking with you.
Oh,
Like I said, I've really enjoyed it, and look forward to doing it maybe in the future. But all the
okay,
best to you and your family, and
that'll be great.
just stay well and keep doing what you're doing, because you're really helping so many people.
All right, thank you so much. And you did a great job here this evening, providing just a wealth of knowledge. So thank you very much. And I look forward to having you on again, Michael. So thank you very much.
All the best. Be well.
Okay, same to you. And for all of our viewers and the people who will listen on the archive, we thank you for taking out the time to listen, to view, and to also help you to, most important, help you to better understand. And I think there's no greater resource from doing that than contacting Michael Prendergast. As you can see through this particular video and this audio, that he did just a great job explaining this. I felt like I was getting a PhD in investing tonight and how to set up that quality investment portfolio. So thank you again, Michael. And for everyone, I thank you for your time and look forward to the next episode that we have with Wealth Academy podcast. Thank you, one and all, and have a great evening and continued excellence in all that you do. Michael, have a great evening, my friend, and I look forward to interviewing you again in the future.
Thank you so much, Paul. Have a great evening as well, my friend, and be well and be safe.
Okay, thank you. And for everyone, go to Apple Podcasts, rate and review Michael Prendergast episode. And that will be episode 178. And I will have this coming to you tomorrow for all the viewers and for all the listeners. Thank you all so much. Have a great evening. Again, my name is Paul Lawrence Van. And again, we were graced and honored by the presence of Michael Prendergast. Thank you so much, my friend.
Thank you.